Hello, everybody. Thank you for joining us for today's public webinar. Hope you all had a great Labor Day holiday. And for those of you, if you haven't heard yet, we are having our final long format intensive, meaning 4.5 weeks long, starting in October, and it will run from October 16th to November 15th. You can go to our website, jimdaltontrading.com, and go to courses at the top navigation. You'll see that the intensive is featured up there at the top. We also have the schedule posted so you can see what special presentations we have and the timings of the webinar. Basically, we got multiple webinars Monday through Friday. On Fridays, we try to only have one webinar. All of the webinars are recorded in case you miss one or can't attend it because maybe timing of a day job or a meeting or your time zone, but they're all recorded so that you can go back and rewatch, and you will have access to your materials for a period of 1 year after the course finishes so that you have enough time to go back and do so. Now, the live intensive does have a prerequisite requirement, and I just wanted to post this here so that we can make it very clear because we always have a couple of folks that for some reason, maybe it wasn't clear to them that we have the prerequisite requirement of the Foundation and Application of the Market Profile e-course, but you must have that. The only exception to that is if you have taken an intensive with us previously, and we can verify that fact. And if that's the case for you, then you would be grandfathered in to be able to join us for a live intensive. And if you aren't certain if you're qualified or you've got questions, we would rather you email us or call us to speak to me prior to placing the order. And just so that you know, we also have discounted bundles right now for those of you who don't have the prerequisite requirement of the Foundation e-course. You get a nice discount for purchasing more than one course. And so we've got the Foundation e-course bundle here, which is relevant to folks that haven't done that yet. And then we also, for people who've already done an intensive with us previously, we do have the intensive and advanced e-courses bundle in case that's something that you're interested in. And for people who are really, really into this, you can go for our triple bundle and get a nice large discount for purchasing all three. But anyhow, you go to our courses page at the top navigation and then scroll down. And that's where you will find all of that information. Okay, Jim, I will give you the screen now.
Thank you.
Okay. There you go.
Okay, my comment on the this last long intensive. We'll do shorter courses as we go on, but hold on. This, I believe, at least intention is to be the best intensive we've ever done. Part of that is that we've just finished a new book. It's scheduled, I don't know if they make the deadline, but it's scheduled to be in the bookstores by the 15th of January. But in doing and writing the new book, I went back through everything quite thoroughly. And I think that makes it fresher in there. And it makes me challenge everything that I've talked about over the years, reinforces those things that I find to be the most effective. And also there's things that weren't as effective or has changed. So it should be very, very fresh in there. Okay, one of the things that I wrote 2 weeks ago, some of you know that we do a short video on the weekend called The Week Ahead. And in that week ahead, 2 weeks ago, what I wrote was that if there is no indication of longer term money in the market, and there was some indication yesterday on the, at least on the tech side selling, but when I talked to one of the major trading desks, I mean, really major trading desks, they were not getting any meaningful long-term trading money selling the market. And what I said in that week ahead, 2 weeks ago, was that if the market is being generally run by short-term money, which I think is the case, then they have a tendency to pay attention to seasonal factors. Longer-term money doesn't pay as much attention to the seasonal factors. But if it's shorter-term money, which is all I've seen in this market for a long time, they have more of a tendency to pay attention to seasonality. And the seasonality is that September is historically one of the worst months in the year. As a matter of fact, the last 4 Septembers have been down. And then the last 3 months of the year on a seasonality basis are relatively strong. So I think what happened, and as this week ahead, as we said, welcome to the fall or welcome to the real September. And September opened, and I think we got massive liquidation in at least the tech area yesterday. Now, one of the reasons when I said that this wasn't an overall breakdown, there were a lot of new highs yesterday in the market. So this wasn't an overall sell-off yesterday. It was more specific because a lot of the consumer goods, consumer staple markets were making new highs yesterday. So I think that is something to keep in mind. Now, I'm going to put up a graphic, and this is what we've been talking about. This week opened up, and it said for the 3rd week in a row, we are starting with the same story. And that story is that the market, this was 10 days, the market has been in a very tight balance. Balanced trading guidelines are, if the market stays within balance, that simply tightens the balance. If the market breaks below balance, go with that breakout. If the market breaks below balance and fails, then fade the market. We had 2 failed breakouts over the past couple of weeks. Each one of these breakouts gives you a little bit more acceptance down here. Now, yesterday we got the real breakout. And where that market's going, it's aiming for this gap down here. Now, yesterday's tempo was extremely slow, one of the slowest I've seen in a long time. That should add an element of caution to the short side. I don't know, but I personally think it's a dangerous short. And also, if you notice, there is no real excess on these 10 days or 11 days. There is a gap up here. So this is excess. The gap is here's the high. There's no real excess on the high, but a gap does serve as excess. That gap also, come across that gap, that has been what has, kind of been the reigning in this market. But there's no real excess on these last several days. We did have a liquidating break yesterday. What it's going for is this would be the reference, would be the gap down here. So this was a downside breakout, and the goal is to go with the downside breakout. Remember, we had 2 that failed, and if it fails, then the odds are that the market rotates to the opposite extreme. It failed, it rotated to the opposite extreme. It failed, it rotated to the opposite extreme. Then you got the breakout. But notice each time it failed, that meant you're getting more and more price acceptance down here. Okay, I don't see much more to say in this market other than that. It's been very weak hands money consistently buying this market for some period of time. Markets have a tendency to change coming into the fall. As I said, seasonality I pay more attention to if I don't see any real long-term money in the market, and I think that's what went on yesterday. Now, where we are right now is, let me go and look at the this late break yesterday, this is what we call a price spike. A price spike is a late break. This is a price spike to the downside, is a late price break that occurs late in the day. And there's not enough time left to know if that late price spike is accepted or rejected. So the top of the spike, and I'm going to call this top of the spike the L period low. The top of the spike is resistance. So if there's any recovery, the market would run back up and get back into this prior range and above the top of the spike. Remaining within the lower spike shows acceptance of the downside breakout and brings that gap into full play. Okay, questions?
Okay, do you consider partial trading days when we're considering gaps in balance, like shortened market hours?
No, I really don't.
Okay, and a question that we often get, or similar, how do you know when longer term money starts to participate?
You don't know for sure. And understand that it's not a question of are they participating or not. They're always doing something. It's a question of when they really are serious. Part of it will be with the volume, but part of it will also be when the market's trading from exacting levels. You know, for example, yesterday morning, the market traded, 3 times right here. Overnight, it traded 4 times at one level. Usually when the market trades from exacting levels like that, that is an indication. That is an indication that it's more shorter term money than anything else. I mean, you never know for sure, but the market will have more ump to it. And while this market went down a long ways, it was really sluggish on the downside. And that's usually an indication that it's shorter term money. For example, look at the M period high. The M period high comes from a tick above half back in L period. The L period high is from half back from K period. When you get this exacting level coming from these exact levels, that is usually the indication that it's shorter term money. Now, when I say the long time's not participating, remember, they're not participating on the buy side either, not at least in the tech area, okay? But these are the tells when I look at these exacting levels, and that's not how longer term money, it's shorter term traders that pick these exacting levels to execute trades, okay?
Okay, are you viewing yesterday as a triple distribution day?
Yeah, I guess the answer is yes, but it's it's overextended, which sets up a very big caution to me that the market more than likely got exceptionally short, and there was a lot of liquidation, but then exceptionally short, exceptionally strung out, and when it's exceptionally strung out like that, that is a caution to you that you don't want to be too enthusiastic on the short side because you can get some very vicious short covering rallies. Now, where are we this morning? You can see the market overnight, how many times we're right exactly at half back. This right here went back a couple of ticks above it. The last little rally exactly to half back. That again is short-term money. So this would be the first reference on the upside this morning. The second reference would be the L period low, which I'm calling the top of the spike. Okay, what else?
Would you consider a gap fill mechanical?
I'm not sure I understand the question.
Like when gaps fill, do you consider that mechanical? Do you think that's mechanical trading?
It depends on how, does it just fill and die there? Does it just fill and carry forward? I have to see it. I have to see the action and see, what happens after the gap is filled. But a lot of times, the markets, if there's goes to the markets trade the levels they can see. For example, that downward gap, they can see that. And shorter term traders tend to hit for those, but they can't make a thing that it's mechanical or not. I mean, you got to look at what's behind it. What was the volume? What was the structure of the market? My caution from yesterday is, yes, we had a late break, but the tempo was exceptionally slow yesterday, which makes me very cautionary on the upside. It makes me very cautious that this market has become dangerously short. Now, it can remain dangerously short for some period of time, but be aware that there's danger in there, and it could spike upward at any moment. Okay.
We've got more than one person commenting about how the NQ had 4 distributions yesterday. Any comments on that?
I say, but because the tech is more heavily weighted in the NQ, and it was a very, very emotional market. I mean, it started yesterday. It started with a big move in the Japanese yen, and that kind of triggered. Sometimes the market just needed a trigger, but I think the trigger was that it was fall. I think the seasonality played a big role in it in coming in the market. And it's not unexpected at all. Like I say, I wrote about it the previous week in there, and so it was something I was watching very closely. Okay.
Okay. What do you take forward from the overnight into the regular trading hours? The point of control, single prints, or gap fills?
No, I just take overnight. The overnight inventory is short in there. And the odds are that you get a short covering rally. If you don't get that, that's a sign that there's substantial additional short-term weakness in the market. But this was the late break. I should have it marked on here. What was the settle yesterday? Who's got the settle?
55.4175. 55.4175 was yesterday's settle.
Okay, so there's the settle. So you can see that overnight inventory is very short. So as we know, the odds of a short covering rally when overnight inventory is short is very high. If you don't get that short covering rally, it's a sign that there's more weakness than we might think. And short overnight inventory is measured from the settle. So almost all the overnight trading was from the settle. And notice the E period high exactly at the settle. Another sign of good odds of weaker hands trading. Remember, short-term traders are going to do what works until it doesn't work anymore. They constantly get themselves too long and too short. Okay, what else?
What do you use to determine if a market is thin or if it's a thin market?
It's experience. It's just experience. You look remember, a market profile. We are not market profile traders. We simply use the market profile to organize the market's continuous two-way auction process. This is what scientists have done for years to organize and observe data. The better the data is organized, the easier it is to interpret that data. But remember that the structure of a distribution curve, which is what the market profile is also informational. And of course, yesterday's profile was very strung out, and that is usually an indication of very emotional selling. But it's that way of the shape of it, the way it's strung out, that suggests strongly to me that it was very emotional selling and liquidation. Really, long-term money doesn't generally kill a market. It's usually shorter-term money selling that's very emotional that gets markets very strung out. Okay.
Okay, let me see here. Okay, as we know, most all gaps fill at some point. So do you lean towards short today and subsequent days since we're right at the top of the ES and NQ gaps?
No, I don't lean anyway today. I'm knowing that the market is very short. And what I will be watching for today is to see, can that spike, rather than, leaning toward one way or the other, I'm watching the spike for information. If the spike, if you find acceptance below the spike, that's very negative on a short-term basis. If you get back above the top of the spike and show any upside continuation, that's a sign of short covering. So I will basically look at the spike. I don't really have a bias in here. When I say I don't have a bias, I have a very cautionary attitude because I know that the market is extremely short. Now, it can remain extremely short for some period of time. However, when I think from an odds standpoint, I will be very careful. Now, you do have a big number this morning. Don't forget, you've got the JOLTS number, comes out a half an hour after the market opens. And then, of course, you've got the employment number on Friday. So those are, the JOLTS number probably will be watched very closely this morning, which comes out, like I say, a half an hour after the market opens.
Okay. Somebody has asked us, and I didn't cover this earlier. So just to let you all know, our early bird pricing discounts end this Sunday, September 8th. So if you're looking to join us, our limited time bundles are the best price they're going to be through the September 8th. And then the price kind of just creeps up a little bit because of the price of the intensive going up, in case you're wondering. We've got this question here, a common question when we're marketing from an intensive. If one has read the book Mind Over Markets multiple times, would that qualify as a prerequisite for the intensive? No, it does not. I just wanted to explain why. So the foundation and application of the market profile e-course is the prerequisite requirement to join us for a live intensive, and that's why we do offer the discounted bundles. The reason why that doesn't qualify is, from the time that Jim's books were written, Jim has modified and changed things over the years. Thus, a new book coming out early next year as well. So, it used to be that we didn't make the foundation e-course a prerequisite requirement. But then what we found over a period of a couple of years of allowing folks to come in who hadn't done that, we got a lot of repetitive questions. It kind of just held back the class for other people, other folks that were there that had those foundational basics already and knew them. So that's really why we did that. It's not a money grab. It's really about, hey, kind of like if you were trying to take a 400 level math course, well, the university is not going to allow you to do that if you haven't done, the 200 and 300 level. So for the quality and quality integrity of the intensive, that's why we ended up making the foundation e-course a prerequisite requirement. And a lot of people, it's sometimes it's like you don't know what you don't know until you realize that you don't know. Okay, so hopefully you understand.
The original Mind Over Markets was written in 90. So you're talking, 30 some years ago. So, there have been substantial changes over those period of time. There were several things that were in Mind Over Markets that just aren't valid anymore. I'm not sure they ever were. When I wrote Mind Over Markets, it was a learning experience because I was really writing about the things I had learned from Stottlemyre. Over the years, I investigated a lot of those things to see if I really thought they had validity. One of the things that people loved that I jettisoned early was the type of openings. They read very nice and sound very nice, but what they didn't do, they didn't recognize that the atmosphere in which that took place, in which the opening took place, made a substantial difference. We did away with initial balance. CTI codes are no longer, available from the exchange. So there's been substantial change that has taken place. So that's why the importance of the other course, the prerequisite. Okay, what else?
Yes, and if you're not sure, like I said, if you did do an intensive previously and were able to verify it, then you can be grandfathered in to join us. Otherwise, we've got the prerequisite requirement. And, feel free to contact us or call me. I'm happy to speak with you to explain stuff or to, look up if you're qualified to be grandfathered. Okay, other questions here. Is there a way to tell how tempo was during the day when I'm not able to watch the market and away from the desk, and then coming back to it, trying to make sense of what happened?
The best thing is to have a replay capability, have a vendor that allows you to replay the day. There's a tremendous amount of learning when you can't be in front of the machine.
Okay. Another question. How many trades does Jim typically do in a week?
No idea. It varies dependent on the week and what the market gives me. I mean, there's days I'll do no trades. There's days I may do 5 or 6 trades. Okay. Don't forget, my machine's a little slow catching up in the morning. So remember, I think the Jolt comes out here in a little while, and I think that's going to be the big focus this morning. Okay.
Okay.
Anything else?
Let me see here. Let's see. If we break and hold back into the L period from yesterday's low, would you look to enter a long position? And would the potential target be yesterday's high?
No, I can't answer that question. How did it get there? You're looking for a mechanical answer. How did it get there? How much volume was there? How much enthusiasm in there? I mean, you just can't answer that question. You got to see what happened before. Okay. Keep in mind as you're thinking about the intensive, I can assure you it may not be the best, but my intention, and I'm a very competitive person, my intention is that it will be a very good intensive. And like I say, I've reviewed everything, and I'm competitive. I want it to be good. I wanted the last intensive, I want it to be the best we've ever done. Okay, anything else, Jim?
Yes. I just wanted to mention that we had to switch to a new provider for our emails. And so if you haven't opted in yet, basically when you sign up, you'll be sent an opt-in email and you have to confirm that you want to opt into our emails. If you haven't done that yet, you might not be receiving our emails. So just wanted to remind folks that if you haven't opted in yet, please do so that you can continue to get our content and our emails. Okay.
Okay, now before we leave, notice that the 8 period high is exactly at half back from overnight. Again, another indication that what we're looking at here is very short-term money. Is that it, Jim, or do we have another question?
Yeah, there is one more question. I just wanted to mention about our NYSE volume. It is no longer working. The company that I think we were getting the data from has gone out of business, and so that's why it's not there. If we are able to find a new source, we'll get that up and running again. Just wanted to address that because I know we had some people curious as to what's going on with that. Yeah, somebody else is just asking about when is the book being released. It's supposed to be in January next year, but we'll see because, you know, publishers, they have their own timeline. Okay. Okay.
Thank you much. Have a great
Yep.
trading day.
Thank you much, everybody, and we'll see you to the next one. Bye-bye.